Everyone, welcome to this quick lesson by Classmore. Today we are going to talk about uh, the new topic, Black Money Act. This act was introduced in 2015 by Government of India, so we are going to discuss the key provisions under this act. To start with, let me just share with you an overview about the sections. So there are total 88 sections in this act, and consist of 7 chapters. And if we look at the sequence of the sections, so first 2 sections talks about the definitions, then the basis of charge into 3 to 4, 5, and then talks about the tax management authorities, assessments, and appeals. Section 41 to 47 talks about penalties. 48 to 58 talks about offenses in the prosecution, and then 59 to 70 talks about 72 talks about tax compliances, and lastly there are certain sections for the general provisions, including notices, cognizance of its offenses, etc. So let us start with the basic overview. This act was introduced in 2015, as I said earlier, by the government to basically tackle the issues of the black money. If you remember, when BJP government came into power, there was a big noise around the black money, a lot of money sitting outside India. So Government of India introduced this act to tackle that problem. This act is basically applicable for the foreign income or the asset held outside India by the resident of India. So it's a very specific act, cover only the foreign income or the assets held outside India by the resident of India. And this act supersedes the Income Tax Act. So if there is any conflict between the Income Tax Act and this act, then definitely Black Money Act will prevail. There are no limits under this act for the reassessments, so the cases can be reopened for any number of years. And there are two more things, important things which I want to share is the undisclosed foreign income prior to the commencement of this act will be covered under the Income Tax Act. It means any undisclosed foreign income of an assessee before 2015 will be covered under the Income Tax Act, while the undisclosed assets before 2015 will be covered into this act. So it means anything beyond 2015 will definitely be covered in this act, whether it is an undisclosed foreign income or the assets. But when it comes to before the commencement of this act, only the undisclosed assets will be covered under this act, and foreign income will be undisclosed foreign income will be covered into the Income Tax Act. Now moving to the next part, which is charging provision that is given under Section 3. So Section 3 talks about the tax rate. So if you find any, if the assessing officer finds that there is a undisclosed foreign income or the undisclosed assets, then he can levy a tax at the rate of 30%. And there is also one concept related to the value of the undisclosed asset. That will be determined based on the fair market value, and the value will be determined for the assessment year where it comes to the notice of the assessing officer. So you can have that asset maybe bought in 20 years ago, but it comes to the notice of the assessing officer maybe last year, then definitely will assess that asset based on the market value in that particular year. One more important point is there is one exemption given under this act, that if suppose you have a foreign bank account which is not disclosed anywhere in your returns, or you have any asset located outside India, and the aggregate of those bank accounts or the incomes or the asset is less than 5 lakh rupees, then this act will not levy any penalty. However, this limit has now been increased to 20 lakh in the Finance Act 24-25, which gives further relief to unnecessary litigation under this act. Moving to the next part, which is section 4, it talks about the scope of the total undisclosed foreign income and assets. So what is undisclosed foreign income and assets? It would be definitely if there is an income from a source located outside India. So it's very important to understand this income which is coming from a source located outside India and which is not being disclosed in the return as you file under section 139. Or income from a source located outside India and you have not furnished the return at all. And or there is an asset which is located outside India, which is an undisclosed asset. Now coming to section 5, it talks about the computation of the total undisclosed income. So there are certain rules related to that. You will not be able to get any deduction or any expenditure or any set off of the losses, which is allowable income into the Income Tax Act. So these provisions are important while we are calculating the undisclosed foreign income and the assets. Moving to the next part, which is like penalties. So we have multiple sections covering the penalty part. Section 41 talks about if there is an assessment happening under this act, and then there could be a levy, which is 3 times of the tax computed by the assessing officer. Then section 42 and 43 talks about the basic rules where if you have not furnished the return at all, or if you have furnished the return but you have not disclosed such foreign income or undisclosed assets, then the penalty would be 10 lakh rupee. But as I mentioned earlier, if the aggregate amount of those foreign income and asset is less than 5 lakh, which is now increased to 20 lakh as per the Finance Act 2024-25, then this penalty will not be levied. And if there are default in payment of tax areas, then penalty could be equal to the amount of tax areas. And lastly, section 45 talks about some more penalties. If you are not able to answer any question from the tax authorities, you're not able to sign any statements in the course of proceedings, or you're not able to attend any meetings, or you're not able to produce the books of accounts, then penalty could be 50,000 to 2 lakh rupees. Finally, coming to the prosecution part, so there are provisions related to the rigorous imprisonment as well under this act. For example, section 49 talks about if you're not able to furnish the return, or in 50 talks about if you're furnished but you have not given the correct information, then imprisonment could be 6 months to 7 years along with the fine. Section 51 talks about if you willfully have done any attempt to evade the tax, then it could be 3 years to 10 years. So it's a very serious offense if you're doing a willful attempt to evade the tax under this act. Or if you made any false statement in verification, then penalty would be 6 months to 7 years, and the abatement, if you're doing any abatement, then also it's 6 months to 7 years of fine. And finally, if you're doing any offense which is second or subsequent offenses, or all the subsequent offenses, then the imprisonment could be 3 years to 10 years with a fine which may range from 5 lakh to 1 crore. So these are the prosecution provisions. So we have covered the key part only for this act. I hope this you find this useful. So thank you so much. Please share your feedback. Thank you.